Hi everyone. Our paper is about oil subsidy removal and spillovers between crude oil and stock markets. Empirical study from GCC countries. The recent issue of using subsidies to lower oil prices has intensified, especially with the global push to reduce greenhouse gas emissions. For example, in Saudi Arabia, the government has spent around 6 billion US dollar between 2000 and 2009 on fuel subsidy. In response to international climate commitments, especially after the 2015 Paris Agreement, several Middle East countries, including GCC countries, have reformed energy subsidies by aligning domestic fuel prices with the global benchmarks, making the fuel price in these countries exposure to international market. This change should make these economies more sensitive to price fluctuations, which could result in higher inflation and necessitate tighter monetary policy. Our study investigates return spillovers between GCC equity markets and key international indices, both before and after the removal of fuel subsidies in GCC. We employ TVP-VAR and unrestricted VAR-based Granger non-causality. Our results reveal that there are differences in how oil prices and stock prices interact in the GCC. For example, we found that in the UAE, there is two-way causal relationship between oil and stock prices, both before and after fuel subsidies were removed. However, in Saudi Arabia, we found that stock prices were linked to oil prices only before the subsidy reforms. We also found that oil volatility impacts all GCC markets during the whole period. Our findings also reveal that the connectedness analysis showing that gold and the US dollar index as a net receivers, confirming their safe haven rules, while interest rate and OVX serve as persistent net transmitters. Finally, our study showed that both during the post-reform, the return spillover dynamic shift with the UAE and Qatar equities, interest rates, and the OVX emerging as key net transmitters.